All right, let's jump right into this equity research explainer. Today, we're doing a complete teardown of SharkNinja, ticker symbol SN. Let's get to it. So the very first thing you've got to understand here, and this is absolutely crucial, is that SharkNinja is not just a vacuum company, not even close. We're looking at a global, multi-category innovation platform. They're playing in something like 39 different product subcategories right now. Think of them as this relentless machine. They enter a space, drop some highly differentiated functionality, whip up explosive consumer demand, and then scale it across the globe. Honestly, if you're just looking at them as a commodity appliance maker, you are missing the entire investment thesis. And how do they do it? Well, the whole business model runs on this relentless flywheel. It literally always starts with step one, pinpointing a really frustrating consumer problem that the existing products out there are just totally ignoring. From there, they engineer some aggressive product innovation to actually solve it. That unique fix, it sparks organic, often viral demand, usually catching fire on social media. And that viral heat gives them incredible leverage to secure massive retail distribution. Finally, they take that proven momentum and hit the gas on international and cross-category expansion. Then, you know what they do? They just rinse and repeat. It's an incredibly powerful engine when it's firing on all cylinders. Now, the result of that flywheel is just a beautifully balanced business. If we look at the 2023 data, the revenue split is almost perfectly down the middle. You've got Shark pulling in 50.7% and Ninja right there at 49.3%. This strategy means they've essentially built two completely distinct billion-dollar franchises. They aren't just banking on one lucky product hitting it big. They own two massive household names that tackle totally different areas of the home. And that kind of diversification, that's a massive competitive moat. It really insulates them if one specific category hits an economic speed bump. And guys, this dual brand power has just fueled explosive top-line growth. I mean, look at these numbers. We're talking about a jump from $3.7 billion in 2022, scaling rapidly up to $5.5 billion in 2024, and they're projected to hit roughly $6.4 billion by 2025. That is an astonishing compound annual growth rate, a CAGR of about 18% over a 5-year stretch. To put that into perspective, building a consumer products company that makes actual physical, heavy hardware and compounding revenue at 18% year over year, that's practically unheard of. It's nothing short of extraordinary. So what's driving all this current momentum? Honestly, one of the most exciting parts of this story is their international expansion. Get this. In the second quarter of 2026, their international sales posted a jaw-dropping 36.6% growth rate. Management has specifically called out some major strength in the UK, broader Europe, and Latin America. You see, the US market is already pretty highly penetrated for them. So successfully scaling this international segment, that gives them a high-octane second growth engine to keep that double-digit pace alive. But you know what's even more impressive than that top-line growth? It's what is happening to their core profitability. Their adjusted EBITDA, which is essentially their operating cash profit before taxes and depreciation, skyrocketed an unbelievable 118.5% from 2022 to 2025. You might be wondering, how on earth did they pull that off with global manufacturing costs rising? Two words, premiumization and efficiency. They managed to expand their gross margins by over 1,100 basis points, hitting 49%. By designing more premium products, tightening up the supply chain, and really leaning into direct-to-consumer sales, they have dramatically padded that bottom line. All right, so this brings us to the ultimate debate for anyone looking at this stock. Do we price SharkNinja as a premium technology growth compounder, giving it a PE multiple of 30 times or more, or should it be valued like a standard commodity appliance maker, sitting closer to a 15 times multiple, kind of like a Whirlpool or Newell Brands? Now, the market has clearly re-rated SharkNinja higher recently, rewarding all that growth we just talked about. But here's the catch. Paying that premium multiple naturally strips away your margin of safety. If that growth suddenly stalls, you could be in for a rough ride. Figuring out exactly what this company is intrinsically worth means we have to run through a few different financial scenarios. Depending on how you model out their long-term free cash flow and that terminal growth rate, the permanent growth rate we assign the company into perpetuity, the fair value swings wildly. We're talking estimates ranging from a $125 bear case all the way up to a massive $280 bull case. If we look at a conservative base case, that puts them right around $175 to $190 mark. Ultimately, this valuation is super sensitive. It all hinges on their ability to sustain a 12 to 15% free cash flow growth rate well into the future. Now let's look at this from a technical perspective. Right after their August earnings report, the stock had this massive institutional-style breakout, jumping over 8% on really heavy volume. But that move established some heavy overhead resistance right up near the 52-week high, around $190 to $192. Beneath that, we're looking at immediate psychological support at 180, a highly attractive first accumulation zone between 165 and 170, and then rock-solid structural support way down at 140 to 145. Think of these zones as the battlefield where institutional buyers and sellers are really duking it out. When we check out the momentum, it's definitely a tale of two time frames. Short-term indicators like the RSI, which tracks the speed of recent price changes, have cooled off to about 45 out of 100. Combine that with a dipping MACD trend indicator, and it tells us the stock has shifted from being overheated into a really healthy consolidation phase. Basically, it's taking a breather. But if you zoom out to the 200-day simple moving average, which is sitting way down near $164, it's clear the long-term trend remains structurally bullish. So what are the future catalysts that could actually push this stock through that upper resistance? Well, a massive opportunity is brewing, pun intended, in their aggressive push into the premium coffee and espresso space. They just rolled out the Ninja Auto Barista, priced at around $949. This is a total game changer. It brings a super high average selling price, and it sets them up for strong, repeatable accessory sales. Plus, premium coffee culture translates so well internationally, making it a perfect synergistic play for their ongoing European expansion. And there is more. We have another massive catalyst in their beauty segment, which just exploded by over 65% in the second quarter alone. Beauty is still only about 13% of their total revenue right now, so the runway for growth there is huge. On top of that, they're heavily leaning into AI. Now, to be clear, they aren't turning into an AI chipmaker, but they are utilizing advanced AI software to rapidly crunch consumer data and iterate on product designs. Management is saying this will dramatically shorten the time it takes to get new innovations to market starting around 2027. That could be huge for the flywheel. Okay, as much as we love the growth, we absolutely have to talk about the risks, and the biggest red flag staring us in the face is the valuation itself. Depending on which specific earnings metric you focus on, this stock is trading anywhere from 26 to 38 times earnings. At those altitudes, the market demands absolute perfection, no mistakes. If they stumble even a little and that 20% earnings per share growth slows down to, say, 8 or 10%, this stock could suffer from severe multiple compression. That basically means the market will just refuse to pay a premium for the shares anymore, which would trigger a pretty sharp drop in the price. When you're digging into those earnings, you really have to play detective. We need to carefully untangle their true organic growth from a one-time $30 million tariff refund that's expected to artificially boost their 2026 EBITDA. That refund is going to add about 15 cents to their earnings per share for the year. And hey, it's a nice windfall for sure, but you cannot plug that into a long-term compounding equation. We have to strip that noise out to see how the core underlying business is actually performing. Another thing to keep a really close eye on is working capital. As of June 2026, their total inventory pile was sitting at $1.144 billion. That's up over 14%. Now, don't get me wrong, inventory growth is perfectly fine when your sales are rocketing up at 20%. But if consumer discretionary spending suddenly dries up and sales slow down, sitting on over $1 billion in physical goods traps a ton of cash. That dynamic could absolutely crush their free cash flow conversion and force them to start heavily discounting products just to move boxes. So let's tie this all together. When we objectively assign probabilities to all these different fundamental outcomes, here is how the math shakes out. If we give a 55% probability to our base case, a 20% chance to the bear case, and a 25% chance to the bull case, the weighted fair value lands exactly around $212 per share. So, at current prices in the 180s, there is certainly upside on the table. But let's be real, it is not some deep value back up the truck kind of scenario. It's going to require some patience. Because the stock is hovering right near its 52-week highs, I'd say the smartest approach right now is dollar cost averaging. That means buying in smaller, set increments over time through specific accumulation zones on any market pullbacks. You'd want to start accumulating if we see a dip into the 165 to 175 range. Now, if broader macro weakness pushes the market down into the 150s, that becomes a very strong accumulation zone. And hey, if it ever sees the 140s again without the core business thesis actually breaking, that is where aggressive accumulation makes total mathematical sense. Ultimately, the entire SharkNinja investment thesis boils down to this vital balancing act. On one hand, you're weighing these exceptional positives: rapid top-line revenue growth, incredible gross margin expansion, massive international scaling, and a proven, undeniable track record of cracking new categories. But on the other hand, you have to weigh all of that against the inherent valuation risk. The operational execution of this business gets 5 stars, without a doubt. But that premium valuation, that demands a careful, highly methodical entry strategy. So, to wrap up this explainer, the underlying business here is undoubtedly an exceptional consumer growth story. They have absolutely cracked the code on rapid innovation and global scale. But I'll leave you with this final thought to chew on. SharkNinja is clearly a high-quality compounder, but do you have the valuation discipline required to actually wait for the right entry price? Because in investing, paying the right price for a great company is just as important as finding that great company in the first place. Think about that as you digest everything we've covered today.